The hidden AG here. April 5th, 2025, silver is at $73.02 per ounce. And while everyone is focused on geopolitical news, dollar movements, and technical charts, the single most important story in the silver market is being completely ignored. China is running out of silver, not running low, running out. Shanghai Futures Exchange warehouse stocks are sitting at 423 tons as of the most recent data release. That's down from 449.65 tons just one reporting period earlier. That's a 26.4 ton drop, a 5.9% decline in a matter of weeks. And it's part of a sustained drawdown that has taken SHFE silver inventory from a historical average of 1,138 tons down to just 37.2% of normal levels. To put that in perspective, 423 tons equals 13.6 million ounces. Global annual silver demand is approximately 1.1 billion ounces. Shanghai Futures Exchange is holding 4.5 days of global silver consumption. Not 4.5 months, not 4.5 weeks, 4.5 days. This is not a buffer, this is an emergency, and it's accelerating. I'm going to walk you through the exact data, what's causing the drawdown, why it's accelerating, what happened the last two times SHFE inventory fell this low, and what it means for silver prices over the next 90 days. Because if you understand what's happening inside Chinese vaults right now, you understand why silver at 73 is not expensive. It's the last cheap price you're going to see before this crisis forces a repricing. The numbers. Shanghai inventory collapse in detail. Let me start with the hard data so you understand exactly how severe this is. Current SHFE silver warehouse stock, 423 tons. This is the most recent reading from early April 2026, reported through ICEIC and SHFE official data sources. Previous reading, 449.65 tons. That means in one reporting cycle, 26.4 tons disappeared from Shanghai vaults. That's a 5.9% drop in a matter of weeks. Historical average SHFE silver stock from 2012 to 2026, 1,138.585 tons. Current inventory of 423 tons is 62.8% below that average. Record high SHFE silver inventory, 3,091.112 tons on January 12, 2021. Current inventory is only 13.7% of that record high. We've lost 86.3% of peak inventory in just over 4 years. Record low SHFE silver inventory, 0.1 tons on July 18, 2012. We're approaching that zone. At current drawdown rates of 10% to 15% per month, Shanghai could hit critically low levels, under 200 tons, within 8 to 12 weeks. Now let me convert 423 tons into terms that matter for the global market. 423 tons equals 423,000 kilograms. That's 13,606,000 troy ounces. Round it to 13.6 million ounces. Global annual silver demand is approximately 1.1 billion ounces. Divide 13.6 million by 1.1 billion, and you get 0.0124. That's 1.24% of annual demand. Multiply by 365 days, and you get 4.5 days of global consumption. Shanghai Futures Exchange, the primary physical silver delivery hub for the world's largest manufacturing economy, is holding 4.5 days of global silver demand. If every silver buyer on Earth tried to source metal from Shanghai at current consumption rates, SHFE vaults would be empty in less than a week. That's not a comfortable buffer. That's a ticking time bomb. Why the drawdown is happening. 4 converging factors. So why is Shanghai inventory collapsing? It's not one cause. It's 4 major factors hitting simultaneously. Factor 1, China classified silver as a strategic material in early 2026. This is not a minor regulatory change. Strategic material classification means silver is treated like oil, rare earth elements, and critical semiconductor materials. It's considered essential to national industrial capacity and economic security. When a material gets strategic classification, state-owned enterprises and major industrial firms receive mandates to build inventory buffers. They're instructed to secure supply chains, reduce dependency on imports, and stockpile for potential future disruptions. That means Chinese institutions are pulling silver out of SHFE warehouses and moving it into long-term strategic reserves that don't show up in exchange inventory data. This is physical hoarding at the state level, and it's invisible to Western market observers who only watch SHFE reported stocks. Factor 2, Chinese solar installation boom. China installed approximately 200 gigawatts of solar capacity in 2024 and is on track for 250 gigawatts in 2025. Every gigawatt of solar requires roughly 350,000 ounces of silver for photovoltaic cells. Do the math. 250 gigawatts times 350,000 ounces equals 87.5 million ounces of silver demand just from Chinese solar in 2025. That's more than 10% of global annual mine production being consumed by one sector in one country. And it's growing 15% to 20% year over year as China accelerates its renewable energy transition. Factor 3, Chinese electric vehicle production. China produced 12 million electric vehicles in 2024. Each EV uses approximately 25 to 50 grams of silver in electrical contacts, battery management systems, and charging infrastructure components. At 35 grams average, 12 million vehicles consume 420 million grams of silver. That's 13.5 million ounces annually. And Chinese EV production is projected to hit 15 million units in 2025, which would push annual silver consumption from this sector alone to nearly 17 million ounces. Factor 4, China's export restrictions on silver. China implemented tighter export controls on strategic materials, including silver, in 2024. This means silver mined or refined in China stays in China. Domestic production doesn't enter the global market. This reduces global supply available to Western buyers, but it also creates a paradox for SHFE inventory. You'd think restricted exports would increase domestic inventory, but it's not happening because Chinese industrial consumption is exceeding domestic production plus imports. China produces approximately 120 million ounces of silver annually from mining and refining. China consumes over 200 million ounces annually when you add solar, EVs, electronics, 5G infrastructure, and traditional industrial uses. The 80 million ounce deficit has to come from somewhere, and it's coming from SHFE warehouses. The global supply deficit, why inventory isn't being replaced. Now, if SHFE inventory is falling, why isn't new supply coming in to replace it? Because there's a global supply deficit, and new mine production isn't growing fast enough. Annual global silver mine production is approximately 830 million ounces. It's been relatively flat for 5 years. New mine development takes 7 to 10 years from discovery to production, so supply can't quickly respond to demand increases. Annual global silver demand is approximately 1.0 to 1.1 billion ounces. Industrial demand accounts for about 600 million ounces. Investment demand, coins, bars, ETFs, accounts for another 200 to 250 million ounces. Jewelry and silverware account for the remainder. Supply of 830 million ounces versus demand of 1.05 billion ounces equals a deficit of approximately 220 million ounces per year. That deficit is being filled by drawing down above-ground inventories. COMEX registered silver in New York is at 76 million ounces, down from over 100 million in January. LBMA eligible silver in London is at 155 million ounces, down from 2021 peaks. SHFE silver in Shanghai is at 13.6 million ounces, down from historical average of 36.5 million. Combined, global exchange-held silver inventories are approximately 245 million ounces. Against annual demand of 1.05 billion ounces, that's 85 days of global consumption. In 2020, global inventories were over 500 million ounces, about 175 days of consumption. We've cut that buffer in half in 5 years, and the drawdown is accelerating, not slowing. The lease rate, confirmation. Institutions are desperate for physical. Here's the data point that confirms the inventory crisis is real and not just an accounting anomaly. Silver lease rates hit 8% annualized in January 2026. A lease rate is what it costs to borrow physical silver for a period of time. Normal lease rates for silver are 0.3% to 0.5% annually. That's what you'd pay in a balanced market to borrow silver, sell it, and return it later. 8% lease rate means institutions are willing to pay 16 to 25 times normal rates just to borrow physical metal. Why would they do that? Because they're short. They sold silver they don't have. They have delivery obligations coming due, and they can't find physical metal to buy in the spot market at reasonable prices, so they're forced to borrow it at usurious rates. Lease rates that high are a scream from the physical market saying, we don't have enough metal. It's the same signal that appeared before the 2020 silver rally when lease rates spiked and silver went from $12 to $30 in 5 months. The combination of falling SHFE inventory, falling LBMA inventory, falling COMEX inventory, and spiking lease rates all point to the same conclusion. There is not enough physical silver available to meet current demand at current prices. What happens when exchange inventories hit zero? Historical precedents? So what happens if SHFE inventory continues falling at 10% to 15% per month and hits critically low levels in 8 to 12 weeks? We have historical precedents. July 2012, SHFE silver inventory hit 0.01 tons. Literally zero. The exchange had no silver available for delivery. Futures contracts that demanded physical settlement couldn't be fulfilled. The exchange was forced to allow cash settlement at prevailing prices. What happened to silver prices? In the 6 months leading up to the zero inventory event, Silver rallied from $27 to $30, a 29.6% gain. Traders who saw inventory falling front-ran the squeeze. 2020-2021. SHFE inventory fell from over 1,000 tons to approximately 200 tons during the COVID supply chain crisis. During that same period, silver rallied from $12 to $30, a 150% gain. The pattern is consistent. Falling inventory precedes rising prices. And when inventory hits critically low levels, under 200 tons, prices spike violently. We're at 423 tons now. If the current drawdown rate continues, we'll be at 200 tons by late June or early July. That's the critical zone where delivery stress becomes acute and prices historically spike. The Shanghai premium. Proof that Chinese buyers are paying up. Current Shanghai silver prices are trading at a 12% to 13% premium over COMEX spot prices. That means Chinese buyers are paying $9 to $10 per ounce more than New York spot just to secure physical delivery in Shanghai. Why would they do that? Because they can't get the metal anywhere else. If COMEX had abundant silver available for export, arbitrage traders would buy in New York at $73 and sell in Shanghai at $82, capturing the $9 spread. They'd keep doing that until the premium disappeared. But the premium isn't disappearing. It's been persistent at 12% to 13% for weeks. That tells you arbitrage is happening. Metal is flowing from west to east. But it's not enough to satisfy Chinese demand. As soon as metal arrives in Shanghai, it gets consumed, and the premium remains. And here's the critical point. Once silver enters China, it doesn't leave. China's export restrictions mean that metal stays in the domestic market. So every arbitrage trade that moves silver from LBMA or COMEX to Shanghai is a permanent reduction in Western inventory. LBMA started the year with over 165 million ounces. It's now at 155 million. That 10 million ounce draw in 4 months is partly due to arbitrage flows to Shanghai. If the Shanghai premium stays elevated, the drain continues, and LBMA hits its own critical low levels by year-end. What the 423-ton crisis means for silver prices. So let's connect all the dots. SHFE inventory at 423 tons, down 62.8% from historical average, falling at 10% to 15% per month. On track to hit critical levels under 200 tons by June, July. Lease rates at 8%, confirming physical shortage. Shanghai premium at 12% to 13%, confirming Chinese buyers are desperate. LBMA inventory falling from arbitrage drain. COMEX inventory falling from industrial demand. What does this mean for silver prices? Short term, next 4 to 8 weeks, prices are supported by the knowledge that Chinese buyers will absorb any dip. If silver falls to $70 or $68, the Shanghai premium widens to 15% or 18%, which accelerates arbitrage buying from Western markets. That puts a floor under prices. Medium term, June to August. If SHFE inventory hits 200 tons or lower, delivery stress becomes acute. Futures contracts demanding physical settlement can't be fulfilled. Either the exchange allows cash settlement at spiked prices, or it halts trading temporarily. Both scenarios are massively bullish. Long-term to 12 to 18 months. The global supply deficit of 220 million ounces per year means above-ground inventories continue falling. By late 2026, combined global exchange inventories could be under 150 million ounces, less than 50 days of consumption. At that point, industrial buyers panic because they can't secure supply chains. Prices spike to whatever level is required to either destroy demand or incentivize massive new mine development. Analysts estimate that price level is $100 to $134 per ounce. Below $100, industrial demand remains inelastic. Above $134, solar manufacturers start rationing silver use or seeking substitutes. Between $100 and $134 is the zone where supply and demand rebalance. We're at $73 now. The path to $100 is paved with falling inventory data, like the 423 tons we're seeing in Shanghai. What you need to watch. Next, SHFE releases inventory data regularly. The next readings over the coming weeks will tell you if the 10% to 15% monthly drawdown rate is accelerating, stabilizing, or reversing. If next week's data shows SHFE inventory at 400 tons or below, the crisis is accelerating. That's a buy signal for physical silver. If inventory stabilizes at 420 to 430 tons, it means Chinese demand and supply are temporarily balanced. Prices likely consolidate in the $70 to $75 range. If inventory unexpectedly rises back above 450 tons, it means either imports surged or domestic consumption slowed. That would be bearish short term. Also, watch the Shanghai premium. If it widens from 12% to 15% or higher, Chinese buyers are getting more desperate. If it contracts to 8% or lower, demand is easing. And watch LBMA inventory. It's at 155 million ounces now. If If it falls below 140 million, London is approaching the same delivery stress Shanghai is already experiencing. The bottom line, the crisis is real and accelerating. 423 tons, 13.6 million ounces, 4.5 days of global consumption. That's what Shanghai has left. China classified silver as strategic. Solar and EV demand is spiking. Export restrictions are keeping metal in China, and consumption is exceeding production by 80 million ounces annually in China alone. Lease rates at 8% confirm institutions are desperate for physical. Shanghai Premium at 12% confirms Chinese buyers will pay whatever it takes. LBMA and COMEX inventories falling confirm the shortage is global, not regional. History says when SHFE inventory approaches 200 tons, silver prices spike. We're at 423 tons and falling 10% to 15% per month. Do the math. This is the hidden AG. The 423-ton crisis is the most important silver story of 2026, and almost nobody is watching it.